What a time to be alive. Don't want to say I told you so, but I told you so. Uh, if you don't know what I'm talking about, which you probably don't because I don't have any views on my videos yet, uh, last few weeks I have been saying that this is a dead cat bounce and that the market has not bottomed yet, that we will see another leg down. And man, did we see another leg down. This is a crazy week. If I flip over to the weekly chart, look at this weekly candle. That's a 9% down move on SPY in 1 week. And this is very rare. I've actually done a study on the times where the S&P 500 closed 8% or more in a 1 week candle since 1950. And I'll showcase those results later in this video when I cover the fundamental analysis stuff. But man, I hope you guys are hanging in there. Um, People in my Discord community very have been feeling that I've been helping them into, managing their risk, making a good plan on how to uh, invest, when to invest, how much to invest, how to manage trades, how to de-risk if they want to de-risk. Um, so if you haven't, please subscribe to this channel and join the free Discord server. I'll put the link in the description. That way you can feel more confident and you can traverse this really volatile market times with a group of people who all want to help each other. And we're all doing it. I'm doing it for free. We're literally doing this so we can help each other. You've got nothing to lose. And I'm making these videos to share my thoughts, but also to provide a track record of my reputation. I post all my trades in my Discord. I don't hide, I don't falsify anything. I'm honest about everything. I'm always available for questions. So, yeah, please, it's just here to help you. So, I'll get started with technical analysis on the market. I always start off the videos with a VWAP Q. It's VWAP anchored to the beginning of each quarter, and with the start of April 1st, we had a new anchor point for our AVWAP Q. You can't see, maybe you can't see it, but it's this white line that's plotted here. AVWAP Q is a really, really helpful indicator. VWAP is volume weighted average price. It takes the price action and the volume over a set period of time and plots a line based off that. And the way you read it is very simple, is if price is trading above AVWAP Q, it's bullish. Buyers are in control. When price is trading below a VWAP Q, it's bearish in the short term, and sellers are in control. If you want to see the previous plot from the last quarter, please check out my previous videos. I always start them off showing a VWAP Q, and you can see for yourself. However, obviously, we're below a VWAP Q. We did close above it once or twice, but I typically don't count the data so soon after like maybe until like 2 or 3 days after the anchor point because it's so fresh. But definitely, yeah, definitely want to pay attention to this right here. We're definitely below it. This is basically the end of the week after the new plot. So yeah, short term still bearish. I've been bearish since we broke AVFQ back in, I think it was February or March. And I continue to be bearish in the short term. In the long term, I'm still bullish, and this is the reason why. I'll flip on the simple moving averages. Every investor and trader should have at least the 50-day, the 150, the 50, 100, 150, and 200 SMAs plot on your chart. So for clarity, I'll turn off these other ones. And I just want to show you why I'm still neutral in the long term. I'm not bearish yet. Obviously, I'm not bullish because we broke below the 200-day and rejected off that really aggressively. Very, very aggressively. Maybe too aggressively, you know? Which kind of makes me excited, which I'll talk more about. But the 50-day is still above the 150-day. Blue is above the green. It just crossed over actually on Friday. So that is starting to change. But basically what I'm trying to get at is that I become bearish in the long-term perspective when the 50 crosses below the 150 and they both slope down. And this is exactly what I want to see. Just like this. This is the cross. You can count this as sloping down, but if you really wanted to be sure and not, bite the bullet and all that, you could plot, a ray from this point. You start seeing diverging downwards, maybe around here. That's when you start going, okay, this is a long-term bear market. We're gonna start making lower lows from here. You can de-risk, you can save cash, you can whatever you want to do. Prepare yourself for another bottom, another lower low. And if you did that in April of 2022, you would have got out, or at least you don't want to sell your stocks. Like that's not smart because you can't predict. But you can make a plan with the new cash you've been saving up. You can de-risk. Maybe if you bought some stocks in this dip, you can sell them for break even at this point, maybe a slight loss. Get that cash back and reinvest at these lower lows. And the final point where you really want to go aggressive is when the reverse happens. When the 50 crosses above the 150, blue above the green, and they both start sloping up around here. This tells you that we're not going to see a lower low. And in 2023 in February, we saw the start of this bull market that we might be ending soon. So that's why I'm neutral. It's getting close, but let's keep an eye on that. And I'll go ahead and I want to talk about a couple things. So first, I want to talk about this week, this 10% drop in 2 days. I personally prefer to see drops like this because the more violent the drop, the more violent the rally, and the shorter we spend crashing. What I mean by that is look at the 10% correction in 2023. All this move with a 10% correction. And this is the 300-day moving average, by the way, if you were curious on this red line, 300 SMA. 10% drop started in July, ended in October. 3 months just for a 10% drop. We had it in 2 days this week. 2022, we had a bear market, that spanned, it was pretty, within the year, but started dropping in January, bottomed in October, almost a full year before we hit the bottom. Look at COVID. COVID's dropped the shortest bear market in history, 30% drop in a month, and we ended up the year positive. Yes, you can say the Feds pumped the market and manipulation, all that, but the markets are manipulated, and it's not going to stop being manipulated. So, you know, we can still expect something like that. Look at the trade war, the first trade war with China we had in 2018. Bottom fell out, or a capitulation, if you will. Violent rally and recovery. Could this be a capitulation bottom? I don't know. I mean, it's definitely capitulation. Will it be the bottom? I don't know. But can we see a rally? Yeah, we definitely can see a rally from here. This is so overextended. Even people I follow who are bears are just flipping long here. I mean, a lot of people see that. It's risky to short here, you know. So that's one thing. And the second thing I want to talk about is these drop targets. So as an investor, when you start seeing the market slash through the 200 SMA, which I've talked about in my previous, I don't want to repeat myself too much, but when you see price slashing below the 200 SMA like this, that's saying we're going to see at least a 10% drop, maybe more. So right away I saw this, I said, okay, let's put target 1, 10%, which we hit. Target 2, 15%, which we hit. Target 3, 20%, which we hit. Now, since we're getting close to a possible bear market, I added a final target of a 35% drop. I got this because this is the average drawdown move of a bear market. It's a 35% drop in between 200 and 300 days, which puts this target at around end of October of this year. Kind of similar to the timeline we saw in 2022. So Will we hit this final target? Are we going to hit a recession? It really does depend. It depends on how the tariffs go, whether or not these tariffs are reduced or increased, and how that's going to impact the economy. We know for sure it's going to impact inflation. However, Jerome Powell did state in the last FOMC that is transitory inflation. And I know you get PTSD from that word, I got it too. But someone fortunately did ask him about that. Hey, you said that inflation was transitory after COVID, and you were wrong. He said, yes, but inflation was seen to be transitory in the first trade war when we had tariffs on China in 2018. So, despite inflation increasing, he still believes it'll just push back the 2% target. We're still going to hit it, it's just going to be later than we expected, thus affecting the amount of interest rate cuts we get. We all know that Trump is really pushing for interest rate cuts. And that the reason why is because that would help prevent a recession. Like it would. Like because after speaking to some people, it was brought to my attention that, the housing market does play a big role in the economy, whether or not people can afford their mortgages. And interest rates have been high for quite a while now. And when interest rates drop, yeah, there are people who do a fixed 30-year mortgage who have refinanced in 2020. But business owners who have buildings, office spaces, those are variable rates. They've been paying high rates this whole time. So interest rate cuts reduces the cost of loans and financing, which boosts economic activity. So that is why you see Trump kind of pushing that. So will we get it? We really need to wait and see again how these tariffs play out. I kind of talked about fundamental a bit early, but I just wanted to point that out as to where my thoughts are in the context of this final target I have here. So, yeah. So where do I think we're going to go from here? I think we could expect to see some kind of bounce very soon, maybe next week. If not, if we don't start seeing a bounce, we could see one more drop down to the 20% target, which is another 3% drop from here. And when we'll see what happens there. Do I think we're getting close to a market bottom in general? I do think so. There is this one indicator I have, the money flow index, which is on TradingView. I recommend checking this out. It's let's see what the author. Money flow index with labels, and basically it's very simple to read. Is that when this indicator oscillates below this bottom line here, which is I believe 25, it highlights this green space and tells you this could be a possible bottom. This triggered in August of 2024, and this was a bottom. Vice versa, when it's right at the top, it indicates to you a possible pullback or consolidation. We saw a pullback here in September. We saw consolidation here in October. We saw, yeah, this took a while to form, but this whole thing resulted in this pullback and eventually this market drop here. So I'm also waiting to see if we get a bottom indicator on the MFI, which we should. And that would be a really good point to sell deep out the money puts, cash secured puts, maybe deposit some money, buy some undervalued stocks, and, and track the market, see where it goes. Another indicator I like using for times like this is the standard pivot points. So as you can see in the standard pivot points for April, we have broken through S2 and we have the final pivot point level, S3. The market will hardly ever break these extreme levels on the pivot points. And look at throughout history. Top or bottom, we rarely ever break through those levels. We always stay within them. We are at the extreme end of this support level here. Guess where the support level is? Right around 490. And where is 490? 490 is right at this target 3, 20% drop level. So I think the most likely scenario, maybe I guess the more negative case scenario, is we trickle down to 20% drop and bounce from there. Have a nice, sharp, aggressive rally that at least fills these gaps here. Maybe up to 535 at this gap, or if even possible at that 300-day moving average over here. Let's go over some fundamental analysis, even though we kind of did a little bit already. But let's go over some of the economic reports we saw this week. We had JOLTS job openings coming in slightly below forecasted amount, but still following this slight downtrend, as you can see from the prior 7.7 million to 7.6 to 7.5. Although it's declining at a rate that is expected. That's important with these economic forecasts, is they want to decline or incline as expected. ISM manufacturing came in a bit lower than forecasted as well at 49. Basically, the way to read ISM manufacturing PMI is if the reading comes in below 50, it's in a contraction or like a recessionary kind of time. When it's above 50, it's an expansion time. So we are now back into contraction for the manufacturing industry. ISM services came in below forecasted by quite a bit. That might have been what caused more heavy selling in the tech sector, because tech sector is more on the services side of things, like software. However, it's still just above 50, not contracting yet. We have non-farm payrolls coming in on Friday with way higher than expected. Basically, non-farm payrolls is like another way to track employment, and it has been on a steady incline, 117 to 135 to 228. So, last but not least, we had the unemployment rate, which basically came in just slightly above the 4.1% level that was forecasted at 4.2%. So, employment's still good. Industries are slowing down. Manufacturing is now contracting. Services is getting near that contraction zone. Basically, how to interpret this? Everyone has a different interpretation. How I interpret it is that in order for ultimately we want to cut rates. That's like that's what we want, because cutting rates stimulates growth, allows cheaper mortgages, cheaper car loans, cheaper business loans, and ultimately the US needs to refinance their debt. That we have trillions of dollars of debt. It's very expensive at the current interest rate levels. They also want interest rates to get cut down so they can reduce their expense there too. So, FOMC has a dual mandate. They've been talking about this since they started this journey. It's their dual mandate is keep inflation down to 2% and keep the labor market strong. Now, inflation has been the 2% target is going to be delayed. That is expected. But now we're starting to see that it's possible for the labor market to start to weaken. Labor market weakening would be a time to cut interest rates. Yes, but at the risk of stagflation. That is a valid concern. I mean, the market's selling off so hard because of so much uncertainty. We don't know, like, all these different variables are so in the air right now. It's very hard to project what could happen. So, don't try to be an economist. Try your best to understand a little bit of what's going on and what the trajectory is, just so you're a bit more informed and can make a rational judgment and explanation of what the price action in the markets that you see in the markets. Next, I want to go over the study I did this morning. This is a study I made a study of all the times the market dropped 8% in 1 week, which is honestly not that many. And I wanted to see how the market returned a week after, a month after, 3 months after, 6 months, and 1 year after. So obviously this is the current time we have now, global tariffs. The week of 3/31, we dropped 9% this week. So during COVID, we had 3 instances, and you see there's yellow and there's blue. The yellow highlight, this is a week where the drop occurred above the 50 weekly moving average, and the blue indicates that the drop happened between the 50 and the 200 weekly moving average. Currently, on this drop, we have dropped between the 50 and 200 weekly moving average. So I highlighted the blue ones because to me, on a technical level, they're the most similar. So during COVID, we had three times. These were the results. And I have a summary at the end, so you don't have to, memorize these numbers. Financial crisis, we had three instances. Dot-com bubble, three instances. 1987 crash, two instances, and 1974 crash, one instance. That is a total of, let's see, including this current time, 13. 13 instances since 1950 that we had this. This is very rare. So like we're kind of seeing history right now. So here we go. If we average all of them, we see that after a week, the week after, the market tends to return 0.5%, so flat. A month after, 3%. 3 months after, 5%. 6 months, 9.8%. And 1 year after, it would be an 18.6% return. What if I excluded the times the market did this above the 50 weekly moving average? If I excluded those times, the week after would jump up to 1.2% return. 1 month, 6.5%. 3 months, 6.5%. 6 months, 11.7%. And 1 year of 23%. And what if I only looked at those two instances in 1987 and 2020, where we dropped between the 50 and the 200 weekly moving average, so below the 50 and above the 200, just like now. We see that the week after, we drop another 6.7% on average. A month after, we come back up to just flat, 0.2%. 3 months later, we have a return of 5.7%. 6 months of 14%. And 1 year, we have a 30% return in 1 year. Again, this study is purely based off price action and technicals. There's no fundamental context behind it. So keep that in mind when you digest these numbers. Hopefully it goes without saying this. None of this is financial advice. Blah, blah, blah. So what do I think of this? I think that based off this, I would not be surprised to see more downside next week. I would not be surprised to hit the 20% uh, drop from all-time highs and enter an official quote-unquote bear market. I wouldn't be surprised. But I would be expecting some kind of bounce within this next month, between April and May, before we continue a leg down, if we have one, or before recovering back to all-time highs and ending this. So let me know your thoughts in the comments. I really would love to discuss this with more people. So if you have any thoughts, please leave them in the comments below. All right, I think I'm gonna end the video here. I feel like it's been going on for a while. I know I typically go over my active trades and trade signal results, but I can make separate videos for that. But if you found value in this video, please comment or like it or subscribe. Please check out my free Discord server. Again, link in the description. And best of luck to all you investors and traders out there.